How to learn stock investing and crypto investing with zero risk. Let's go. If you are getting started with investing, it could be scary to risk your hard-earned money, even if you tried it before and you lost money, or if you heard of friends and family members losing money, it can deter you from investing. I'm here to tell you that you should not be scared, and there's ways to learn how to invest without actually risking any money. Only thing you'll need to dedicate is some time and practice. I will show you today on how to do this.
Don't ask them, what do we know? What I forgot is better than whatever they remember.
Hi, welcome to Delta Code. I am Delta, an economist with 20 years of investment experience, and I'm here to share my investment journey with you and how I invest my money. And hopefully I can help you learn how to invest, because I do think it is one of the best ways to reach financial independence and to secure yourself and your family's future. When you are working, you're trading your time for money. But when you are investing, you're putting your money to work, and that money works 24/7 while you are asleep. If you can imagine, each dollar you save and invest is an employee that goes out there day after day and earns money for you. So having capital is same as having a business. You become a business owner. In economics, a business owner is called capital or capital owner. And they deploy their capital either to buy machines, real estate, or employ people to produce things and sell them. Well, the capital can be put to work in finance, as a financial instrument, buying stocks, crypto, bonds, other financial instruments. Now, all this can seem overwhelming at first and scary, especially because it's new. I'm here to show you how to do this risk-free as practice until you get comfortable, until you test out your knowledge and your strategies and your models. And if and when you get good at consistently making money with your ideas or the way you choose your investments, then start putting in a little money, a little capital at a time, and see it grow. Once your capital starts growing, it tends to snowball and multiply many times over. At first, getting your total amount of capital to a level that will yield significant amounts is a little tough. The toughest part is saving that first $1,000. After that is saving more and investing that $1,000 to getting it to $10,000. Then comes the really hard part, is being patient, continuing to save and getting better at investing until that $10,000 becomes $100,000. That is as hard as it gets. After your $100,000, the safe interest you can make on that by investing wisely will start to compound very quickly. And the next $10,000 will come from investing and not from you saving and working. Getting to $1 million from that point is not as hard as you think. So for today, we will use Yahoo Finance. Just go to www.yahoo.com and click on the Finance tab or Personal Finance. There, we will go and create a portfolio. If you see here, I have many different portfolios, and some of these are real portfolios where I track my investments as one of my investment tracking tools. I also like Yahoo Finance because they have a lot of stats and news about companies, but primarily I like it because you can create a mock portfolio, which is fake portfolio, where you don't have to put in real money, but you can pretend like you did. So you can pretend like you bought 5 shares of Google because you think now is a good time to buy Google, but you don't want to risk your money because you don't have experience. Well, pretend you bought it right now at the price you thought was good, or the news that you think is about to hit may make the price go up, and see what happens. And do this diligently, check in at least weekly or monthly, or make a portfolio today and then check in on it a year from now and see how well that portfolio did, or check in on it 5 years from now. Whenever you feel like you'll be ready to deploy your saved money. At that point, you'll know whether how to do this because you already tested out your knowledge by building a portfolio. So I will take you step by step on how you do this. It's very simple and intuitive. Okay, so once you're at Yahoo Finance, go ahead and click Create New Portfolio. So you can link to a brokerage account, you can import a CSV, or you can create manually. For this, we will do create manually. We'll click continue. We will name it. What should we name it? We'll name it 101 Invest. Okay. Keep it in dollars. We'll do total holdings. Okay. So once you create a portfolio here, you can start adding symbols. Now, how you add a symbol is a couple of different ways. One is you can just click, and if you know the ticker symbol, you can confirm, like Tesla is this, but maybe you don't know it's TSLA. You can just type in Tesla and TSLA will pop up. Same here. When you click add symbol, see it says that VZ, that's Visa, AAPL is Apple. So you can just start typing Tesla and it will pop up here. There's different Teslas. It's usually the first one, equity, but when we look at Chinese stocks, they're called ADRs, American Depository Receipts. There's a little nuance there. So let's add a Tesla, and now let's add a Chinese stock like Alibaba, equity, New York equity. And there's also Alibaba that trades on the Hong Kong exchange. We'll have that one, and then we have BYD. This is also Chinese. Now, see, this one's a little different. This one's harder. This is pink sheets, and there's a couple of different ones. So you'll have to click on these and figure out which one it is that represents the BYD shares you want to buy in the Chinese EV manufacturer. Okay, so we got Alibaba, we got BYD, we got Tesla. Let's see, let's get some Intel, which is INTC. Okay, and let's do maybe Meta. What else? Meta, Tesla, Coinbase. Let's do Coinbase. Coin. Okay, I think that's enough. So once you have picked out your companies and added the symbols to your portfolio, the next thing you want to do is add a purchase. The way you do this is add a transaction. Now, this is where I like to also add notes. So let's say we bought today, current price is $235. Say we bought one share. Commission is usually 0. And then notes, here is why I like to write down why I bought this at this moment in time. So for Coinbase, we are buying one share. Let's say we'll buy 2 shares. And we're saying the reason we're buying is Q2 looks good and crypto bull market. Now, the reason you want to write notes is you want to be intellectually honest of your reasoning of why you're buying this. If you check back a year from now, 2 years from now, I have portfolios like this that go back 15 years or 20 years. And I like reading why I bought these things. What was my reasoning? How did I grow as an investor? Was my rationale correct? Do I have good intuition? Things like that. So next one is Meta. One share is about $500. So if you buy one share, it will be about the same price as we paid for 2 shares of Coinbase if we want to have equal weight for each position in our portfolio. And let's say it's under $500, which we find attractive. And because US will ban TikTok soon, we think that that will be good for Meta stock. This might be already priced in. So let's consider that as an option and maybe write more notes about that. Intel, goodbye, I don't know, what is that? 25 shares. And the reasoning is Taiwan Semiconductor is in Taiwan and there's tensions with China, and we think that will become a problem in the future. And America passed the CHIPS Act that gave Intel billions of dollars to create a fabrication plant, I think in Arizona and Texas. So in 2025, they will start producing out of these plants, which will be good for their stock because their revenue is going to go up. And so on and so forth. For BYD, we can say, hey, they're a competitive auto manufacturer from China. They have better economies of scale and vertical integration than Tesla. We think that they will export more across the world and eat a lot of the EV market share, as they have done already. Alibaba, it's trading at, let's do like 5, 6, 7. Let's do 7 shares. It's trading at a historical low, at a price to earnings ratio that is very low compared to what it started trading at when it launched an IPO, but since then it's grown like 20x its revenue. It's a leader in cloud in China, in AI, and basically Amazon of China. Tesla, we know Tesla, autonomous driving, robotics, solar. They're a leader in a lot of things. We think that all that is bright future, but let's write that down in our transactions or why we think in our notes, and that's it. And then once you have your portfolio completed, let me just finish with Alibaba and Tesla. Tesla shares are, so you can buy like 3, I think. Okay. Save. We have to save these transactions. Yeah, so don't forget to click save. Okay, so all these things are accounted for. And there we go. We will do this. So our portfolio that has 2, 4, 6 stocks of about 5 to, oh, we overshot it here. Let's adjust that. Why did we put so many? Let's do 20, right? 18. There we go. That's more in line with an equal weight of about $500. Do we not buy BYD? Yeah, we forgot to do that. We can buy what? 8. Okay. So here we go. This is our about $3,000 portfolio of equal weight, about $500 per stock of 6 different stocks. And this is our 101 invest portfolio. Now we can check on this every day. We could check on this some other time. We can look at different factors that contribute to us making a decision. One of these factors or metrics is price to earnings growth. If you can look here, the price to earnings growth for these companies here for Coinbase is 0.24, for Meta is 0.84, for Intel is 0.71, and then for BYD is 2, for Alibaba is 52, and for Tesla is almost 5. So a price to earnings ratio that is 1 or under is considered good. It means how much the premium you're paying for the stock shares is, how is it relative to how fast the company is growing. If this number is small, that means the company is growing very fast, which often justifies that number. It means the price to earnings, PE ratio, might be high, but if the price to earnings growth is low, then you understand why. It's because they're a fast growing company and they are growing into those valuations very quickly, and investors think it's justified. So one of my portfolios that I have, it's just price to earnings growth. I made this in, October of last year. And here are the companies that had a low price to earnings growth. And I believe I wrote notes on each one. Yeah, so here I wrote notes. The price to earnings growth here was 0.11. And that was the important metric for this test portfolio. I wanted to know how this strategy of just using this one factor to make a portfolio would impact, and we'll check on this once a year is complete. But so far it's up 26% since I bought these things. And here's the price to earnings growth. They were all at 1 or lower. Highest one was UiPath, and here's where they are now. So Elastic was 0.8 and now it's 5, but the stock is up, 34%. So far, this strategy works. You can see they're not all winners, but overall, that's not bad. 26%. Now, the question is, did I even do an equal weight on these shares? But this is an example of how you can practice investing. If you learn something like price to earnings growth, PEG ratio, well, make a portfolio and test that if that is a really important variable that you should pay attention to. Maybe it's the only one you actually need. Price to earnings growth or price to earnings. And then you just make a list of, let's say, 50 companies. And then out of those, you pick out, 10 that have the lowest price to earnings growth and that you understand well their business model and narrative. And then check in a year later or two and see how well your portfolio is doing. If this number is positive, good. Also, compare it to this blue line. The blue line is the market. This is the standard portfolio comparison. This is your portfolio, the red, and the blue is basically the market. So are you outperforming the market? If your red line is consistently under the blue line, then you really don't have any edge in investing. Your choices are not making a big impact. You should just buy an index fund, which most people should do. Stock picking is hard, you can get it wrong, and it takes a long time to learn how to do it right. So majority of your money should probably be in the index fund, and then have a smaller portion of the money you're investing in a stock picking portfolio that you have perfected through testing it first and not risking any money. But in the immediate short term, it's always good to be invested in the market because time in the market makes you more money than timing the market. It is really hard to guess the bottom of the market. And if you miss out on just 10 of the big days when the stocks go up, you lose vast majority of your potential profits. So if you just invest gradually, consistently, little bit each month over many years, that will compound and be worth a lot. But as you're getting started, you can also make a portfolio just like this of index funds, S&P 500, the NASDAQ, maybe ARK Invest, whichever index funds you may have learned about that seem good. You don't have to put your real money into it right away. Put it into a fake portfolio on Yahoo that you make. Write down the notes of why you bought it. Did you read it in the Wall Street Journal? Did you see somebody on the news? Did a friend tell you about it? Maybe have a portfolio for each investment friend you have and what they recommend, and see which friend's portfolio performs the best. And then in the future, when that friend mentions a company they're investing in, perhaps give it more weight than a friend whose portfolio is not doing so hot. This is a really fun tool. I highly recommend it. This is the best, the easiest way to learn investing risk-free. Now, the important thing I want to mention is when you invest fake money, your emotions are not real, because if the stocks go down, you don't feel that pain. If the stocks go up, you may feel regret of not having put in real money. But when you invest real money, emotions are much more heightened and you will feel each loss more, especially if the money you work for you earned the hard way and there's a lot of emotional value attached to the money you're investing. If your investments go down, it can be painful, it can make you doubt yourself, it can make you want to sell, so you reduce how much you lose. The risk aversion is a very strong emotion. If prices go up, it may lead you to put in money that you shouldn't, thinking that you're a genius. That is why it's important to do this as practice for maybe 6 months, a year, maybe several years before you actually invest real money. Just make sure that your portfolio is outperforming the generally accepted portfolio, like the S&P 500, that your line is above the market line, and that you are being intellectually honest when things don't work out. Also, luck is a huge part of investing. If you built your portfolio in 2020, when the market was down, 30% in March, pretty much anything you would have bought would have almost doubled for you by the end of 2020 or into 2021. And you might have felt like a genius. And then market corrected 30 or 50% because there was a lot of inflated prices due to money printing. So having a longer time horizon, being intellectually honest by keeping notes of why you bought what you bought, why you sold what you sold, and even having a target. Say Facebook Meta is now 500. I'm going to buy it today and I'm going to sell it when it goes to 600. That's a 20% gain. You can even put a limit order in your real stock account to sell at 600 because you plan to do that. That was the goal. Get the 20% and get out. That's a shorter term strategy, but also good to keep those notes. I'm buying this now for this price. I think this company is worth this much, and I will sell it when it reaches this valuation, unless there's new information that makes me think it's undervalued further and there's more growth. So that's it for today. Please invest responsibly. If you find value in my content, give it a like and subscribe. I appreciate every one of you. And as always, may the force of compound interest be with you. Peace.